Imagine for a second that you are standing in your backyard. You've got a fire pit going. It's a nice evening, but instead of throwing a log on the fire, you reach into your pocket, pull out a stack of $100 bills, and just toss them in.
That is a painful image, viscerally painful.
It is, right? No sane person would do that. We obsess over gas prices, we clip coupons, we negotiate vendor contracts. But here is the brutal truth we need to confront today. Most business owners are doing exactly that, metaphorically torching cash every single day. And they don't even smell the smoke.
That's the scary part. It's silent. We're looking at this concept of lighting cash on fire, specifically through the lens of business owners in places like Stark County, Ohio, hardworking, industrial backbones of the economy. But hard work doesn't equate to business wealth, and that is a distinction that trips up so many entrepreneurs. They mistake revenue for wealth.
That's a massive distinction. Revenue is just vanity, right? Isn't there that old saying? Revenue is vanity, profit is sanity, but cash is king.
Exactly. But let's take it a step further. In the context of building real business wealth, the kind you can retire on or pass down, profit isn't even the whole story. It's about transferable value. See, you might have a business that generates $1 million a year in cash flow. That sounds fantastic. You're living large, driving a nice truck, taking vacations. But if that business relies entirely on you being there to unlock the doors, answer the phone, and solve the crises, you don't have an asset. You have a high-paying job with a lot of liability.
And a job is much harder to sell than an asset.
You can't sell a job. That's the lighting cash on fire part. If you are spending your profit on lifestyle perks today, rather than reinvesting it into systems that allow the business to run without you, you are essentially burning the future sale price of your company.
Let's dig into that, because I think a lot of listeners might feel a bit attacked right now. They're thinking that, wait, I built this, I deserve the perks. And they do, but you're talking about the multiplier effect, aren't you?
Precisely. This is the math that changes lives. Let's say you're running a business and you have some inefficiencies. Maybe you're overpaying for insurance, or you have a messy inventory system that wastes $10,000 a year. Not a huge amount for a big company, right? Just the cost of doing business.
Sure, $10,000 is a rounding error for some.
But when you go to sell that business, buyers value companies based on a multiple of their profit, usually EBITDA. Let's say your industry multiple is a 4x. That means for every $1 of profit you show, a buyer pays you $4. So that $10,000 you wasted, you didn't just lose $10,000, you lowered your exit price by $40,000.
Wow. Okay, put that way, it stings. You're not just spending $1, you're destroying $4 of future equity.
And that's a conservative estimate. In high growth industries, that multiple could be 6x, 8x, or 10x. So, lighting cash on fire isn't just about wasteful spending today. It's about eroding the legacy you leave behind. In Stark County, where you have these generational manufacturing and service businesses, the tragedy occurs when the founder wants to retire, calls a broker, and finds out the business is unsellable because they treated it like a personal ATM rather than an investment vehicle.
That brings up the lifestyle business trap. We see this a lot. The owner runs personal expenses through the business, the country club membership, the family car. They think they're being smart by reducing their tax burden.
It's the classic penny-wise, pound-foolish scenario. Yes, you save 30% on taxes on that expense. But again, go back to the multiple. By artificially suppressing your profit to fool the IRS, you are also fooling your potential buyer. Now, a good broker can do what's called recasting to prove those were discretionary earnings, but it makes your books look messy. And messy books scare buyers. Risk is the enemy of value. If a buyer has to spend 3 months untangling your personal life from your business expenses, they're going to offer you less money. Period.
It's like trying to sell a house where every closet is jam full of junk. The buyer assumes the foundation is cracked because you clearly haven't taken care of the details.
That is a perfect analogy. And let's look at the operational side of burning cash. It's not just money, it's time. If you, as the owner, are the only one who knows how to quote a complex job, or you're the only one who has the relationship with the biggest client, you are the bottleneck. Every minute you spend doing a task that could be delegated is money burning. Why? Because you aren't working on strategy. You aren't working on growth. You're working in the business, not on it.
I want to pivot to the psychological aspect of this. We're talking about Stark County, a place known for grit, blue-collar ethics, pull yourself up by your bootstraps. Do you think that mentality sometimes backfires? Like the owner thinks, I need to be the hardest worker in the room, so they never build a management team?
That is a profound observation. Yes, absolutely. There is a cultural badge of honor in being the first one in and the last one out. But in the context of valuation, that heroism is actually a liability. A buyer looks at a company where the owner works 80 hours a week and thinks, I have to hire 3 people to replace this one guy. That drives the price down immediately. Real wealth building requires the humility to say, I shouldn't be necessary.
That's a tough ego check. To become wealthy, you have to make yourself irrelevant.
It's the ultimate paradox of entrepreneurship. To maximize the value of what you built, you have to design it so it doesn't need you. And that requires systems, standard operating procedures, automation. If you don't have those, you're just lighting potential on fire. You're relying on tribal knowledge, stuff that's only in your head or your foreman's head. If that foreman quits, does your production line stop? If yes, you have a massive leak in your value bucket.
So let's get practical. If someone is listening to this driving to their shop right now and they realize, oh no, I'm the bottleneck and I'm burning cash, what is the first step? Is it just cutting costs?
No, don't just slash costs blindly. That can damage the business too. The first step is a valuation audit. You need to know what your business is worth today and identify the value drivers. Maybe your customer concentration is too high. If one client makes up 40% of your revenue, that's a massive risk. You need to diversify. That adds more value than cutting the coffee budget.
Right, focusing on the big levers.
Exactly. Clean up your financials. Stop running personal expenses through the company for at least 3 years before you plan to sell. And start documenting everything. If you were hit by a bus tomorrow, morbid, I know, could a stranger come in, read a manual, and keep the business running? If the answer is no, start writing that manual today.
It's interesting because this shifts the timeline. People usually think about an exit strategy as something you do 6 months before you retire. But you're saying this is a way of operating from day one.
If you wait until 6 months before you want to sell, it's too late. You've already baked in the inefficiencies. You've already lost those multiples. Building real business wealth is a discipline. It's the discipline of treating your business like an investor would, not like an owner would. An owner gets emotional, an investor looks at the machine. Is the machine efficient? Is it scalable? Is it durable?
That emotional detachment seems key. We love our businesses like our children, but you don't sell your children. You do sell a business.
And that's where the friction comes from. When a buyer comes in and points out the flaws, the cash fires, the owner gets defensive. We've always done it this way. Well, that way is costing you $1 million in exit value. So you have to choose. Do you want to be right or do you want to be wealthy?
Oof. Do you want to be right or do you want to be wealthy? That's the bumper sticker right there.
It's the reality. And look, in an area like Stark County, there is so much potential. The work ethic is there. The market demand is there. If you combine that grit with sophisticated financial planning and operational discipline, you create a dynasty. You create wealth that changes your family's trajectory for generations. But you have to stop looking at the cash in the bank account as the scoreboard. The scoreboard is the enterprise value.
It really reframes the definition of success. It's not about the cash flow you extract today. It's about the capital you accumulate for tomorrow.
Precisely. Think about it this way. Every dollar you waste on inefficiency is a theft from your future self. When you tighten up operations, when you diversify your client base, when you build a management team that can operate without you, you aren't just making your life easier today, though you are doing that too. You are literally printing money for your exit.
It's empowering, really. It takes the mystery out of it. It's not luck, it's engineering.
It is engineering. Financial engineering backed by operational excellence. And the best time to start was 10 years ago. The second best time is this morning.
So, as we wrap this up, I want to leave our listeners with a challenge. We started with that image of burning money in the backyard.
Right.
I want everyone to look at their P&L statement this week, not just at the bottom line, but look at the processes behind the numbers. Where is the friction? Where is the dependency on you?
And ask yourself, if I had to sell this company next week, would I buy it? If you're honest, and the answer is no, or only at a discount, then you know exactly where your work begins.
That's the question. Would I buy my own business? A terrifying but necessary question.
It's the only question that matters.
We'll leave it there. Stop lighting cash on fire. Start building a legacy. Thanks for the deep dive today.
Always a pleasure. Let's get to work.